Alright, so today we will have a quick session on financial consolidation and how we can quickly do financial consolidation. So let's understand the concept so that we can execute it quick and fast and with minimal or no error, if I may. So the couple of consolidation methods that we're going to talk of today is the full consolidation method and the equity method. So when do we use a full consolidation method? So when company A holds greater than 50 to 100% of equity of company B. So in this case, we say that company A has full control on company B, and the consolidation method here that we will use is full consolidation method. Now, when the holding is 20 to 50%, then we use equity method. Now I'll take some quick examples, and then which are there in the next tabs. So the underlying concept remains the same, right? So the intent is to understand the concept, and then we can extrapolate this concept to financial statements, which are big, exhaustive, with multiple asset lines, multiple liability lines like current liabilities or long-term liabilities, assets, current assets, fixed assets, investments, and so on, right? So let's jump into the full consolidation method. So we have taken an example here. So if you see here on top that parent invest $1,200 in subsidiary, right? That is the holding is 100% of equity shares of the subsidiary, that means they have full control. So let us look into whatever I'm highlighting, that they have spent $1,200, but the equity capital of the subsidiary, that is the entire equity capital, is 100 shares at the rate of $10 per share. So the equity capital is of $1,000, but they have spent, parent A has invested $1,200 on the subsidiary for $1,000 of shares. Okay, so when they do this, the immediate accounting entry in the books of the parent, which is column I, what I am highlighting on top right hand, initial acquisition is investment in subsidiary $1,200 debit and cash or bank credit $1,200, right? So now if I see column B, which I'm highlighting now, where this is the balance sheet of the parent. So the investment in subsidiary comes there under assets. Then they have some assets, and assets there, some intercompany receivables from the subsidiary, $50. And then we have the share capital of both parent and subsidiary, retained earnings of parent and subsidiary, the liabilities of both, and then we have intercompany payables to the parent. So the intercompany payables of 50 matches with the intercompany receivables of 50. For the subsidiary balance sheet, again, is the same thing. They have some assets, they have share capital, retained earnings, liabilities, and some interco to the parent. All right. So if this is a scenario where we have two financial statements, okay, of company A and company B. Company A is the parent, company B is the subsidiary. Company A holds 100% of equity, 100% of equity, in the subsidiary. So now how do we do the consolidation and quick and fast? So here, first of all, what we need to do is that we will just ignore the goodwill for the time being. We'll come to it later. When it's investment in subsidiary, now because we're consolidating, and when we're consolidating, it is one and only company. So we cannot have an investment in an own company, right? So in the investment in subsidiary will be eliminated. Okay. The quick way is, for assets, we have to just do A plus B, that's parent plus subsidiary. So you see 2525 is 1300 plus 1225. Now intercompany receivables and intercompany payables. So again, we cannot have anything, that we can receive from ourselves or pay to ourselves. So they have to be eliminated. So if you see interco receivables is null, and below in the group consolidated balance sheet, which we are trying to do now in column D, the interco payables is also null. right? Then, so this is we do. Then we come to the liability side. When we are consolidating and we are using the full consolidation method, so we will just put in the share capital of the parent. Okay, we will just put in the retained earnings of the parent. We will add the liabilities of the parent and subsidiary A plus B, right? This is and interco I've already spoken of. So the thumb rule is that add the assets of parent and subsidiary, add the liabilities of parent and subsidiary. Okay, bring in the share capital of only parent. See, I've mentioned there in column E also. Bring in the retained earnings of only parent. Okay, assets and liabilities we have spoken, and the rest we eliminate. Now, how do we get the goodwill entry, right? So if you look at column I and elimination of investment in subsidiary. So this is what happens. So if the holding is 100%, then I debit the share capital of the subsidiary 1000. If you see here in column C, the share capital of subsidiary is 1000 and retained earnings is 100. Okay, so I debit, because it's credit, I debit to nullify it. Share capital 1000, retained earnings debit 100, so it gets nullified. Then I have to eliminate investment in subsidiary. Remember, we spoke that in a group consolidated balance sheet, the investment in subsidiary will be null. So to do that, we have to reverse the entry. The initial entry was investment in subsidiary debit, so we do an investment in subsidiary credit. Okay, so we remove the share capital or eliminate share capital and retained earnings of the subsidiary, and we eliminate the investment subsidiary which is in the parent's book. The balance is goodwill. So this means that for an 1100 of equity, I had paid 1200. So the balance debit goes to goodwill, which comes here in the group consolidated balance sheet. All right. So I hope this is quick and easy. So again, we have to, when we are drafting the group consolidated balance sheet, we add the assets of the parent and subsidiary A plus B, liabilities of parents and subsidiary A plus B. Just note down or bring in the share capital of parent, retained earnings of parent, right? And then we do this elimination of investment in subsidiary. We write this journal entry where, because it is, we have to eliminate the share capital retained earnings, right? Because it's an own company, right? We cannot have anything, any shares in an own company, right? So basically, so we remove the eliminate by the share capital and retained earnings by debiting them, remove the investment in subsidiary of the parent by crediting them. The original entry was debit, and we get the balance as goodwill, which goes into the balance sheet. Now, if you see, by doing this, the balance sheet has tallied. The total assets is equal to total equity plus liabilities. Now, what if the holding is less than 100%? Okay, say here in this example, parent invests $1,000 in subsidiary and 80% of holding. In this case, in addition to goodwill, and a concept of minority interest also comes in, right? So if 80% is the majority holding, then 20% is the minority interest part, and that is as per accounting standards or IFRS, that has to be shown in the balance sheet, that is in the group consolidated balance sheet, the minority interest. Okay, so this, now again, this is the column B is the parent, or parent balance sheet, where we have investment in subsidiary 1000, the initial investment, right? If you see column J, it is investment in subsidiary debit to cash. Okay, so I have made an investment, I've paid $1,000. Then we have the similar assets for both, interco, payables, receivables, share capital, retained earnings for both, liabilities for both. So what we do as a thumb rule, as I just explained, first, okay, I will not write the investment subsidiary because that is to be eliminated. I will write the combination of the asset value A plus B. I will not write interco receivables, interco payables in the consolidated balance sheet because they are going to be eliminated. I will just write the share capital and retained earnings of the parent. Okay, I will total the liabilities of parent plus subsidiary A plus B, right? Then if you see column I will similarly do an elimination journal entry to eliminate the share capital retained earnings of subsidiary against the investment in subsidiary by the parent, get a goodwill. And now for minority interest, okay, so if you see here, for minority interest, right, the 20% of the share capital, which is 20% of 1000, if you see column C, and the subsidiary share capital is 1000 and retained earnings is 100. Okay, so for minority interest, I will do a 20% of 1000, okay, and I will eliminate that as a debit. I will do a 20% of 100 of retained earnings, I will eliminate that, okay, as a debit, and then the balance goes to minority interest of 220, right, which you see here on the liability side of the balance sheet. Similarly, I forgot to mention one thing when we are doing the elimination of the investment subsidiary here, because the holding is 80, so I will eliminate 80% of the subsidiary capital, that is 80% of 1000. I will eliminate 80% of retained earnings of subsidiary, that is 80% of 100, which is 80. I will eliminate the entire investment in subsidiary of the parent, which is a credit. Balance goes to goodwill. So here on top, it accounts for 80% of the equity holding, and here at bottom, it accounts for the 20% of the equity holding, right? Which 20 and the 20% as per accounting standards should be shown as minority interest in the balance sheet. So I hope this was easy to understand. So it is a very quick way of doing it. Now if you have multiple asset lines, you can always extrapolate this concept to those financial statements, right, which are expensive. Now going to the equity method, okay, so when the holding is 20 to 50%, right, so let's take an example that when the holding is 20 to 50%, we say that company X, which is the company which holds company Y, has significant influence on company Y. So we have taken an example that let X has 25% holding, right? So we have the balance sheet of X, balance sheet of Y, and the consolidated balance sheet, which is column D. So here we have typical the assets of both the company, share capital, retained earnings, liabilities of both the companies. Now when we have a holding of 20 to 50%, okay, unlike full consolidation method, we used to record that as an investment in subsidiary, right? If you see here, this asset in the parent company. But for equity method, we will not record that as an investment in subsidiary, right? So that is why if you see in column X, which is the parent equivalent of full consolidation, it is null. We will, for equity method, we will not record any investment in subsidiary of the holding company, right? Then how do we do the consolidation? So I will come for CBS of X, which is column D, consolidated balance sheet of X. Okay, this investment subsidiary of 25, I'm coming a bit later in a bit. So here again, in equity method, I will not combine both the assets. Okay, I will just put in the asset value of the parent in the consolidated balance sheet, then share capital of the parent, okay, right, and then I'm coming to retained earnings and then liability of the parent. So in equity method, I will just put the assets of the parent, share capital of the parent, liabilities of the parent, and investment subsidiary I will not record initially in the parent. Now for investment subsidiary, refer journal entry. So if you see here, column H, okay, just because it has 25% share, right? So what I will do is that I will take 25% of the earnings, the net income of the company being held, which is Y here, and which you see 100 here in column Y, column C, right? Retained earnings 100. So I will take 25% of 100, which is 25, okay, and I will debit investment in subsidiary 25, okay, in the consolidated balance sheet, and I will credit share of net income of Y by 25, which goes into the or which gets added, if I may, to the retained earnings of the parent. Okay, so if you now go and see here in the investment subsidiary, we have 25 coming in because there's an investment subsidiary journal entry, a fresh journal entry, a debit. And if you see this, and if you see the verbiage here a bit, this is the parent retained earnings plus share of net income of Y. So parent retained earnings is 275 and share of net income of Y is 25, which becomes 275 plus 25, which is equal to 300. All right. So as a recap, when we have an equity method of holding, 20 to 50% holding, we will not record investment in subsidiary, in the holding company. When we are consolidating, we will just put in the asset, liabilities, and the share capital figure of the parent. We will write a journal entry which is equivalent to the percentage of holding into the net income of the subsidiary, okay, which is 25 here, and the journal entry will be investment in subsidiary to share of net income of Y. The investment subsidiary will go to the asset side of the consolidated balance sheet, which is here, and the share of net income will get added to the net retained earnings of the parent, so which becomes 300. Now if we receive a dividend, okay, so what will happen if we receive a dividend? So here when we receive a dividend, then the journal entry for dividend, if you see column H, cash dividend received from Y, it's a cash debit, okay, which is 5 has come into a bank account, and the investment in subsidiary will be reduced by the amount of dividend because I've already gotten some dividend, right? So in this case, if you see, everything remains same. If you see the liability side, the share capital of 2000 of consolidated balance sheet, okay, column D, that's what I'm speaking of. The retained earnings of 300, okay, which includes the net income of Y. Liabilities of 200, they remain the same. What changes in investment subsidiary and asset figure? So investment subsidiary on top was 25. Now it has got created by 5, so it becomes 25 minus 5. And the assets, that is, I've gotten cash now. So cash is a part of asset. So it was 2475 asset. Now cash in hand has increased by 5, so it becomes 2480. So this is how the equity method is, or this is how we consolidate or we draft the consolidated balance sheet, by the equity method. I hope this quick tutorial, helped you. Please subscribe, to get more such kind of videos and information or knowledge that I could share with you all. Thank you.